Good afternoon. Welcome to our Friday Fun Fest in the world of wealth. So many things to talk about, update, and give you a few teasers with as we move forward in this process of winning during inflation. But thanks to my followers and other people who have listened to seminars, a person just gave me a new tagline. They've called me the Wealth Whisperer. And I like that, because I honestly believe this and mentioned it several times. If you hear it for the first time, you're hearing it for the first time. I believe money talks, but wealth whispers. A lot of the things we talk about, I wouldn't tell a lot of people you're doing. Just quietly do them and reap the results. If you want to share, that's fine. But bottom line is, the reason we have a lot of people building wealth quietly is they don't give out all their secrets. At this stage, I'm willing to give out a lot of secrets. Hopefully you will do them. But you make a decision. I believe your wealth is much better attained when you don't talk about it, but actions speak louder than words. So we're going through a lot of different things today as we build on our 10 commandments. And as you saw from the flyer that went out in the teaser, we're going to talk about the HELOC again, replacing the first mortgage, and I got some great news. Then we're going to look at how you win with ACEs as part of the whole strategy of my 10 commandments of wealth building. So with that said, let's move forward and see where we're going. First of all, I always have to remind you of the 5 links in the wealth building chain. The awareness stage was the ahas, and I would feel very strong that you're picking up some ahas, some awarenesses as we spend time together once a week. Then the next step is, now that you occurred to you what you could do, you decide to do it by setting your goals. And goals need to be practical, attainable, and reasonable, i.e. something written down, not something I want, but something you want. You can't do goals of somebody else's. This needs to be your goals. As you well know, my basic focus, like a laser beam, is having every realtor that I touch my mind with to buy at least 2 income-producing properties per year. We'll talk about that more in a few moments. Then you've got to make the commitment to do it. And then above all, avoid the instant gratification that takes some of the money away that could be used to build wealth. There's good debt, there's bad debt. Nothing wrong with debt. But are you buying things that are instantly gratifying you? That's considered bad debt. And then the time perspective. We talked about the rule of 72s, the rule of 114, the rule of 144. We'll go back to that in future sessions. With that said, though, our perspective that we're going to be pouring today is based on the process of just reminding you of the power of the first lien HELOC that we covered last week. And we mentioned it, gave you some good examples. I would hope that you took some time to go online and look at things. I would hope that if you're here for the first time, you go back and look at one of my previous videos from last week that's on my Facebook page to learn about what we covered in terms of replacing a first mortgage and using a first lien HELOC. And again, I'm not endorsing any company. I'm not saying I would necessarily be the only company to look at, but I did find out a few days ago that we now have a company called Aven, A-V-E-N, that allows you a credit card in front and your HELOC in the back. It's a home equity backed credit card, which is exactly the concept that I've been preaching. Put all your money, all your pay, all your bonuses, all everything, all your commissions into your HELOC to reduce your loan on your first HELOC, or first mortgage, as you might call it, to keeping the interest down. Remember, please remember, it is not the interest rate that's the problem. It's the loan balance. With interest rates as a major concern of people, I think we have to be realistic. So I just pulled up some data before I came on today. This data came from Freddie Mac, and you're welcome to go online and see this in more detail. But the average interest rate for the entire year on 30-year mortgages in 2018 was around 4.80%. It went up to 4.87 as a high. It went down, but it averaged about 4.80. That was 2018, not that long ago. Just finished April. The full data for the whole month of April, according to Freddie Mac, is 4.98, almost identical. 4 years later, the interest rate for 30-year mortgages is almost identical. Now, Unfortunately, as we see these rates creeping up, I got the data from today. The average 30-year mortgage, according to the Freddie Mac, is 5.01% as of 5/26. So even that is not that bad, but we do see the trend that it's still rising. More importantly, as we said, every 1% interest rates go up, we lose 11% in our mortgage buying power. With that said, yes, rates are almost the same. The problem is the prices went up, so the loan balance could be more. Once again, people, it is not the interest rate that drives how you build equity and wealth. It's how you pay down the balance as fast as you can, as quick as you can. Wayne's World says borrow as much as you can, pay it off as fast as you can. I would suggest you take a look at home equity backed credit cards. I'm sure this isn't the only one, and you don't need the credit card if you just have checks from the HELOC, but the credit card gives you advantages. But I would use a credit card to make my purchases. So let's cover that rather quickly to remind you of something I said last week, or reinforcing it if you were here. If you weren't here, it's new. So today is the 26th. I need to buy a wash machine. I'll be reimbursed by my home warranty company, but I need to go buy a replacement wash machine. I'm going there right after we have our little mental snack here in Wayne's World. And I'm going to buy that wash machine. I'm going to put that on a credit card that had a billing date of the 24th of May, which means I will not get a bill until June 24th for that wash machine. I will have to pay it until July 24th and pay no interest. Now, the check I get from the warranty company to cover that is going to go right in an account. If I had a home equity line of credit on a first mortgage, it will reduce my mortgage for that 2-month period by that amount of money. Doesn't seem like a lot, but then I have an insurance policy that comes due. Then I have other payments that come due. Maybe I got a big water bill from one of my apartment buildings. Maybe I've got some other expenses. Maybe I got a homeowner's policy coming due or a car coming due, all on the credit card. So I don't think we need the credit card in front, HELOC in back. It's just more convenient. But credit cards with a HELOC are even better. I think I feel, because my feeling brain is much more powerful than my thinking brain. I feel the multiple credit cards with different billing dates is the way to make sure I use other people's money for as long as I can at no cost to me, because I pay all my credit card bills in full. So we now have programs available. This idea seems to be catching on, but I have to tell you this, people. Nearly 20 years ago, I started this. And my first home equity line of credit with a new bank in my town was good for 10 years. After 10 years, they looked at the way I used it and they decided not to renew it with me. I had to apply someplace else because I wasn't using it the way they intended. They thought I'd be making very little principal payments and just keep that high balance of interest. But I was using it by doing exactly what I said last week, what you can do by understanding how to use the HELOC to replace the first mortgage and bringing the balance down as quick and as often as I can. So I paid less and less interest and pretty much brought the balance down to zero rather than have interest only and still have a full balance. With that said, you have to make the decision to spend some time looking at this. It's not easy to understand. I had an accountant, a good CPA with a lot of reputation, who had a hard time understanding what I was suggesting. So I'm not saying you have to latch onto this real quick, but make sure you understand what you're doing. So consult your tax advisor, consult your attorney to make sure you understand what we're talking about. But with that said, we can move on a little bit to what our topic is, I guess you'd say, for today. That's win with aces. Now, you know, if you're any kind of a gambling person, a hand of 4 aces is pretty good. The odds of being beat in a poker game when you have 4 aces out of 5 cards and have no wild cards is pretty slim. There's not a lot of options available that someone can beat you with. The odds are huge in your favor. So we'll take a look at this today from the perspective of wealth building and why I believe your odds are in favor if you build wealth using ACEs. And what I want to say is, what was isn't. I don't know what you did in the past. I don't care what you did in the past. It's your decision how you want to handle looking back at your past. But I know what is won't be. Obviously, interest rates are rising. At some point, they will come down. But once again, even though we make so much of an issue about all these interest rates rising, as I just said, they weren't that different than all of 2018. The only problem is we have higher prices, which means higher mortgages for most people or more money down. But either way, it's posing a difficulty. Most people don't have the extra money down. They have to find a way to borrow more money if they can. There's the dilemma. So I got to pay that down as fast as I can. So how do you win with ACEs? Well, I'm not going to define wealth. Wealth can be different in Kansas City, Missouri versus Memphis, Tennessee versus Tampa, Florida versus Peoria, Illinois versus Madison, Wisconsin, or any other city you want to pick. Just as we have different price points. A multi-million-dollar house could be a huge luxury house in certain parts of the country. In some places, look at the 10 top zip codes and see what $1 million buys. Probably nothing even available for $1 million in the top 10 zip codes in this country, or a very little place. So wealth is, I guess, individualized, so to speak, but also it's localized. As you well know, it takes a lot more to live in one town than another town. So we all fill out tax returns. As you well know, one of my 10 commandments of wealth building is to avoid taxes like poison. Avoid taxes like poison. So, 4 tax forms that as I talk to people, as I consult people, as I ask friends, I found out that these 4 forms tend to be the 4 most common forms that everybody I've come in contact with is doing very well in their wealth building strategy, no matter where they're at. They fill out a Schedule A, they fill out a Schedule C, they fill out a Schedule E, and they fill out a Schedule S. So first things first, number 1, are you filling out a Schedule A, a Schedule C, a Schedule E, and a Schedule S? If you're not, that's your first step to winning with Wayne. Once you've realized the power of those 4 tax forms, of all the other forms that the IRS has in wealth building, then the question becomes, what tips, techniques, strategies, tactics can I use to get the biggest benefit from each one of these forms? And we'll start doing that, and we may have to continue this into another session. We will see. So, no order of importance, but Schedule A is the one that many people in regular jobs, paying salaries and hourly wages, and being on commission, anybody earning wages of some sort, fills out a Schedule A if they have enough deductions. Some people take the standard deduction, and we're going to talk about why you may want to do something in Wayne's world we call leapfrogging. So Schedule A is itemizing your deductions. And if you haven't looked at a Schedule A, it's got your insurance and medical, it's got your interest, it's got your taxes, it's got casualty losses, it's got other miscellaneous deductions, contributions, donations. You got to keep track. You got to have records. So you got loads of software out there to keep your records on for all those items. Many of them correlate with your bank accounts and your credit card accounts to move things into a system that you can usually use for doing your taxes, or you give it to a tax accountant. But either way, are you maximizing your medical deductions? Are you maximizing your interest? Are you maximizing your donations? Here's the problem. A few years ago, we passed something, we did, our illustrious Congress with the Senate and the House in Washington passed a bill that pretty much is called the SALT bill, state and local taxes. They capped it at $10,000, which meant a lot of people as consumers using a Schedule A now found they don't have the same types of deductions. unless they're very, very, very ill and have very little insurance, or they make lots of donations or have a huge casualty loss, the odds are they're going to be limited and lose a lot of the potential money. So my suggestion has been, since that act was passed, as a realtor, as a real estate professional, how much of the items you used to pay out of pocket as a consumer, your insurance premiums, your donations, your contributions, other thing, interest on your home mortgage, can you move to a business, to the Schedule C or the Schedule E? There's a big, big, big tip to make sure you're maximizing the ability to avoid taxes. Because now I'm transferring that debt over to my business, and I'm just taking the standard deduction on my taxes for Schedule A. On the other hand, I might want to play the leapfrogging game because I have enough other expenses as I talk to my accountant or do it myself. Maybe 1 year, because I don't want to put my home mortgage or my first lien HELOC on my business. That's your choice. I think it's a decision you have to make, but it's going to cost you money if you listened last week. But if you choose to itemize deductions, Schedule A, with as much as you can, then you might want to think about this strategy, i.e., this year, 2022, I itemized deductions. So last December, I made a January payment to my home mortgage by paying the December payment in January instead of December. At the end of this year, I'll make my January 23 statement in December. So this year, I'll have 14 months of interest on my mortgage loan. And last year, I didn't itemize, and next year, I won't itemize. So every other year, I itemize, I don't itemize. I itemize, I don't itemize. And I accumulate. I might prepay my dental bills, my medical bills in December of this year. I'll try to put as much into medical as I can. So I'll prepay my dentist. I'll prepay a doctor. I'll prepay an insurance policy. I'll do anything I can that's within the tax code that allows me to prepay 2023 expenses into my 2022 tax bill. What's that do for me? It gives me more big deductions in the year I'm itemizing. Next year, I'll only have 10 payments of mortgage because I've prepaid January's this last December, and I'm going to pay last December's in January. So you're leapfrogging, as I call it. That's a strategy. Take a look at it, do the numbers both ways, see if that makes sense. I'm still of the opinion, and will always be the opinion, that if I can move as much as I can over to my Schedule C, profit or loss from business profession, or any tax forms I use for my LLC or corporations, and my Schedule E, which is rent and royalty income, I'm going to be better shape. So once again, my HELOC that replaced my first mortgage was put on one of my income properties. And there is no rule and there is no law that says you cannot use a HELOC on an investment property. Which means then now all the interest on that home whose loan I moved over to a HELOC secured by my income property goes against that income property's expenses on my Schedule E. All I'm doing is shifting an item that might not give me as much of a tax benefit as I itemize on Schedule A to my Schedule E. I also will move many of my expenses. I might provide health care for my entire family as part of my business because I've got them as employees. And so 100% of their health care as an employee package in my business is for my family. I'm moving my deductions over to where they create a bigger benefit to me, i.e. a bigger bang for the buck. And I've avoided taxes because the tax laws changed and it's less and less attractive to be to be deducting using a Schedule A. So Schedule A is good. Keep good records, take care of things. Above all, do not do something a lot of people are not doing, sometimes not on purpose or on purpose. Ignorance is bliss, but it's no excuse with the IRS. Many people over the years were able to not have sales tax charged when they bought things online or out of state. Your responsibility by law, at least in the states I know of and the states I live in that have income taxes, state income taxes, is you must report that what you didn't pay in tax to the state of Illinois, in my case. So I have to let the state of Illinois know how much I spent or bought and paid taxes on through the internet or out-of-state purchases. It's been on the tax forms for 20 years. They make it simple. If you don't want to keep all the records, you can take a flat number. So if you're not going to buy something huge like appliances or TVs or cars or other things out of state, maybe you can just take their standard deduction. But you cannot avoid paying sales taxes because you weren't charged them due to an out-of-state purchase or an online purchase. Now, it's pretty much more so a common sense practice that almost everybody selling to you online that's a retailer who has presence in your state is charging you the sales tax. I just ordered 2 pairs of socks online. Sales tax, $3.67. Somebody else orders something else. So all I'm suggesting is sales tax is in the state you're in. The use tax is what a state charges you for products you brought into their state and used but didn't pay sales taxes on. So please make sure as you fill out your state tax returns, the use tax form or the use tax section is filled out honestly, accurately, and completely. Otherwise, it's an audit and it poses a problem. And since many of the out-of-state purchases are done on credit cards, it's easy for a state to track the stuff you said you didn't buy, whether it's cigarettes, whether it's furniture, whether it's appliances, whether it's you shop on eBay every day or go to the QVC home shopping clubs. That brings me to that first thought process. Schedule A, shift as much as you can over to the other tax forms. Schedule C, which is your profit and loss on your business and profession. Now we have a couple of options there. One of which is the use of your home office as your business. And there are many rules of thought on that. But above all, if you're going to use your home and show a profit, you can write off a portion of your utilities, your lawn care, your maintenance, your cleaning services on Form 8829. On the other hand, it might be better to avoid that and do what you can to get down to a very low net income, but still have some income, because you cannot use 8829 if you show a loss on your Schedule C. And a loss is not anything to be ashamed of. If you are running a valid business, a real estate business, and you do have a lot of expenses, and you will if you capitalize on many things that you can do, especially towards the end of the year, you will be able to show a loss on paper or possibly a very low income. And we'll talk about that as it relates to the S in the A.C.E.S. So my thought for you is to take some time to look at Schedule C, download the free instructions from the IRS, look at all the potential options, each item, each column, and see what it is you do and what you can do to maximize your earnings. And there's a lot of categories there that you could be doing things on. Obviously, buying things for your office. I'm sitting here in my office. I've got 4 monitors. I've got my lights. I've got my desk. I've got my printer. I've got my other equipment. I've got a phone. I've got a nice clock. I've got some pictures. Those are all items in my office that I was able to, quote, depreciate because they're in my office. And this is used exclusively for seminars with you and people coming over to meet with me. So we got chairs. Bottom line is, almost everything you use in your business of being a realtor, a real estate professional, is going to be deductible on Schedule C. But the only real exclusion is You can't deduct your clothes unless you have a permanent company logo or name on the clothes you wear, or you keep them in a separate location because you have an office you go to. So, for example, all the people you see on TV, the talk show hosts, if they keep a separate wardrobe on site, that wardrobe is tax deductible. If you want to wear your company logo shirts and put the seal of your real estate firm on all your coats and pants and things, you should have a tax deduction, but consult your tax advisor. I'm not advising it, I'm saying it's a possibility. What we're saying, though, is it's hard to think about something you can buy for your business that's not tax deductible. And half of your meal costs. Once again, though, documenting. Schedule C and realtors tend to create a potential audit problem, or maybe sometimes call it a red flag, because the IRS does realize some realtors don't keep good records. A good Schedule C to win with ACES has built into it tremendously detailed records by day, by month, documentation with invoices, credit card payments, everything in case there is an audit. And the philosophy in Wayne's world is you should welcome an audit. You should not fear an audit. What the Wealth Whisperer says to you today is you will never know if you paid the least amount of taxes legally until you've been audited. I have found many times the IRS found some extra deductions for me that I wasn't aware of. So my theory is if I do this to avoid taxes, not evade taxes, because that's illegal, I don't mind being audited because I did everything and I have my record keeping there. It just has to prove it all. And so it's an inconvenience to take it all down to the IRS office and sit down and have them go through this stuff. But the bottom line is I now leave there each time knowing I paid the least amount of taxes as possible. And sometimes I make a mistake, and sometimes I have to pay more, and sometimes there's a penalty. But I wasn't aware of it. I didn't do it on purpose. I just didn't know. So I pay the price. On the other hand, I've learned a lot. So Schedule C is a tremendous tool. And once again, if you are not treating what you're doing as a hobby, the IRS says you can lose money. It's nothing wrong with losing money. Ideally, it should be making some kind of a profit every 2 or 5 years. But it doesn't have to be a lot of profit. It doesn't have to be a lot of profit. You want to find as many legal, legitimate deductions against your income so you can avoid taxes like poison. So as you look at Schedule C, you might see some areas that are better for you. Car expenses. You have a couple of options. Do you want to depreciate your car and keep track of all your expenses? Or do you want to just take the flat 57 or 58 cents a mile depending on the year? Well, if I have a relatively new car or a leased car, maybe I should look at just keeping track of the mileage at 58 cents a mile. If I'm not depreciating the car, not taking all those tax benefits, I'll just take the flat fee. And it's much easier to keep records on just counting my miles, my business miles, my personal miles, my commuting miles. And that's taken care of in the tax forms. On the other hand, if you're more detailed, want to keep detailed records, want to depreciate the car, you can use that depreciation method that's standardized by the IRS for cars. But either way, I still can write off my tolls and my car washes, whether I itemize each expense or take the flat 57, 58 cents a mile, whatever it is that year. I think it was 58 cents this year, if I remember correctly. Not positive. But whatever it is, it's much easier for me to just keep track of my mileage in a mileage log each day. Start with mileage this, add so many personal miles, so many commuter miles, so many business miles, end of the day, end of odometer. There's even programs out there will do it for you very simply in your phone. You've got other issues, advertising, marketing. Many of you buy a lot of gifts for your clients. I hope you understand. And if you haven't, this is the time to realize this. The IRS only allows up to $25 for gift purchases for clients. Now, nothing ever happens till something happens. But if you're giving away a $100 item to somebody on a house closing, You only can write off 25, unless it can be moved over from gifts to advertising. So we have several companies. In my seminars on negotiations and wealth building, I have tremendous sponsors. One of my, I say, best sponsor to explain some tax benefits for gifts is Cutco. Cutco knives make great closing gifts. My local rep, Ari Aberman, is a tremendous person who helps me build my business by sponsoring my programs. He'll be sponsoring my Zoom class I'll talk about at the end of the month to get your certification to be a certified negotiation expert on Zoom for 2 days. But his company allows you to write off all you do at the full price. If you give somebody a $300 set of knives or an $80 piece of a knife, you still can write it all off. You're not limited to the $25 maximum. And for somebody maybe buying a multi-million-dollar house, you might want to give them a $200 or $300 gift. Well, if it's a gift, it's 25 off. If it's something like Cutco, it's $400 off, whatever the price was. So the concept of maximizing Schedule C is looking at all the different places where each one of those items, how can I maximize my mileage, my magazines, my travel, my insurance, all the items, my expenses for other things. Pretty much, other than the clothes you wear, you can write off the cost of your business. The dry cleaning, the shoe shining, all shows up. Again, the car washes, the tolls. You get your I-Pass toll card, whatever it's called in your state. They give you a running total. You can see exactly which ones were your business tolls. Line them up, total them up. There's a deduction. I do believe a lot of agents leave a lot of deductions on the table by not keeping good records. And that is our downfall. We are not exactly steady and compliant people, according to this theory. We're dominant and influencing people. The majority of agents are dominant, influencing type personalities. We're not the record keepers. But if you can discipline yourself to do that, you reach maximum deductions. Now, we could spend a lot more time on Schedule C. You have to go back and look at it and look at which areas you want to learn more about, and then just start Googling or researching or talking to an accountant and say, can I do this? Can I do that? Can I do this? Can I do that? There's loads of information that they get yearly, especially if your account specializes in your business model. So you would want, if you're using a CPA, to make sure they understand some of the current tax laws regarding real estate. I remember back in 1998, H&R Block did not know. That was the first year. Thank you, Bill Clinton. Thank you, Bill Clinton, to pass legislation and sign it that allowed us to have unlimited passive losses against our income. So I'm writing off well more than $25,000 because the depreciation on my buildings plus my expenses in the computer at H&R Block wouldn't take it because they were filing my taxes. I did them, but they filed them. They said, there's something wrong. It won't take it. You got a mistake. Something a mistake. Their computers, their system was not set up to realize that real estate professionals, realtors, could have unlimited passive losses because of new legislation. Now, to me, that told me right there, just because they're a large accounting firm doesn't mean they know everything. There's a lot to learn. IRS has got loads of rules. So sometimes you got to do the work yourself and say, hey, I think I can deduct that. Hey, I think I should be able to write that off. Hey, I believe this. And then take the advice as you want it from the expert you hired. But again, there's a lot of things changing. That was a big one for me. Big one for me. You win with ACEs. So itemizing deductions, go through that whole list. Now, profit or loss from your business or profession, go through that list and look at the items and keep track of things. We buy a lot of ad specialties. We do a lot of other things. Maybe it's magnetic signs. Maybe it's just candy we give away at our desk when people come to the office. keeping track of all those legitimate business expenses is powerful. Coupled with that is the concept of what's called a Section 179 deduction. Please take a moment as soon as you can to do some research on what Section 179 does for you as you depreciate your assets. So as I mentioned, I'm sitting in my office. I've got a router. I've got a big clock. I've got pictures. I've got various kinds of items you would consider antiques. I've got screens. I've got four screens going, a laptop, chairs, couches, massage chair. It goes on and on and on. I can depreciate all that over a period of time, according to the IRS rules. But Section 179 allows me to write off the entire amount in that first year. So if I buy this new touchscreen laptop that's got 4K projection on it, and it cost me $2,000, I can write that off entirely against my income for 2022. If I buy a new TV and put it in my house because I want a bigger TV or one that's a smart TV, and I paid $1,000 for that, I can write the whole thing off. I can expense the entire purchase price that whole year versus spreading it out over a period of years. Now, I can't do that with my income property. I can't take a refrigerator that I buy and write the whole thing off. I got to break it down. But in my personal office, on my Schedule C, anything I buy for this office, I can expense. If I buy a new camera, a new phone, credit card reader, whatever I want to buy. So take a moment to look at how Section 179 can accelerate writing off your expenses against your income. So you'll find many people about October start looking at how much money they earned in 2021 or 2022 and start thinking, what kind of things could I buy that possibly would reduce my income liability for this year? Because I'm going to have an income of so much money after I pay the bills. What about writing some things off by buying something? And we could talk about that in much more detail. I actually did that for people who needed to buy a house and take money out of the stock market and avoid the capital gains by paying the loan down with discount points. I'd love to share that with you in the future. So Schedule C has the ability to tie in with it the depreciation that can be accelerated using Section 179. That's the law. It's on Form 4562. So download 4562 from the irs.gov/forms. Download the instructions. Take some time to read this stuff. There's still time to go back and get caught up for 2022 to make it easier when December 31st comes at the end. Start thinking about paying this year's taxes. There's still time to catch up. We're only 5 months into the year, so you were able to make sure you're doing what you could, and you got 7 months to put this into practice and make it work. So plan your strategy to avoid taxes like poison by looking at 4562, by seeing how the 179 deduction can benefit you as a realtor in this marketplace. My guess is I probably should have talked about something else that may come back to me, but those are the highlights of why this is so powerful of a tax form. The next one is why I guess I love what I do. Schedule E, rent and royalty income. And boy, I got to tell you, it's not just the rental income that can impact your bottom line and save you on taxes. It's your royalty income and the costs. We all talk about side hustles and multiple streams of income, blah, 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 blah. Well, here's where the rubber meets the road. You got your business, you're selling real estate, you fill out a Schedule C. Versus a friend of yours who works at an hourly job or at a factory or store, they get paid in salary or wages. They only fill out a Schedule A. They don't have a business. They don't have any rental property and don't have any royalties. So they don't fill out the C and the E. And you don't win just with the A. The A is a good grade in school. But the A is not a wealth building letter. Some of the smartest people that I went to school with who were A+, valedictorians, salutatorians, don't have nearly the wealth that many of us who were at the bottom of the class. I got to be honest with you. I was in the 10% of my graduating class. I was in the 10% of my graduating class. I made the top 90% possible. I was not the smartest in the room. I wasn't the most studious in the room. But you know what? I felt maybe I gained my common sense and hard knocks and the things that some people do. And I'm not saying that to not be comfortable with people that are smart people, but I do know the people with the A's weren't always the people that built the most wealth. So the A is good, but the CES is where I think you really shine. You win with aces. So you're already in your business. Now we got to make sure you maximize your rent and royalty income. Once again, every property you own will go on Schedule E. Now, there could be some changes if you're into a syndicate or you're in some kind of a partnership, but for all practical purposes, a person like me fills out a Schedule E for all their properties. Keep track of all my income, track of all my expenses, everything I buy, use, and have to pay for to run that building, that home, that property is going to be tax deductible. People that are cleaning the place up after somebody moves out, the people that are doing the grass right now, the people that are putting the new roof on or cleaning the windows, everybody has expenses. All expenses are included in Schedule E. So obviously, we keep track of a lot of things. I would recommend you try to use one credit card for your business expenses, one credit card for your personal expenses. Some people have multiple credit cards. They have one for their business, one for their investments, and one for their personal. I don't care how you do it, but it's much easier if you got things segregated with all the possible credit cards. And then we have to realize, as part of the business model with a Schedule C and with the stuff I spend on E, is many cards offer a lot of benefits, i.e. rebates. I first learned of the Spark business card at the NAR convention in San Diego. I'm going to say that was, forget how long ago it was. It wasn't recently. It's been 13 or 14. Probably 14, I think. Whatever the San Diego convention was back then. They ever had a booth. Capital One had a booth. Offered me a bonus if I would sign up for the Spark credit card. And ever since then, I've been getting a 2% cash back on everything I buy. My appliances for my buildings, my personal stuff, I get 2% cash back on each one of my Spark cards. So I'm going to buy something new for an apartment house. I've got to replace something. I'm paying the guy with a credit card to do some installations. All goes on the credit card. Now, I also know that there are certain other cards that create business. So, for example, I have a Costco card, not because I shop at Costco. I want the rebate of 4% when I go buy gas. 4%. So at $5 a gallon, and I don't know if you're above that or below that. I hope you're below that, but maybe you're above that. But at $5 a gallon, that's 20 cents off a gallon just for using that Costco card at any gas station I go to. Now, here's where my wealth building mind comes in. Forget the ACEs for a moment. So I go to the Shell station on Wednesdays because they have a discount at the gas station, use my Gas Buddy card to get 3 to 10 cents off a gallon, and use the Costco card to pay for it. Now, if you just think about that, the discount from Shell on Wednesdays, the Gas Buddy card, depending on how much I buy, anywhere from 3 cents a gallon to 10 cents a gallon, and sometimes there'll be a bonus up to 25, and then 4% of the purchase price on top of that. Yes, I don't like high gas prices, but I don't pay high gas prices because I've got those cards. So I've got a Costco card that I basically use just for gasoline. And I keep my miles separate so I know what I'm doing per mile, but I'm saving a lot of money. Now, once in a while I shop at Costco, but I'm not a Costco shopper. I mean, it's rare when I go to Costco. I think I got a rebate last year of like $2.87 or something, some ridiculously low amount, because I don't spend a lot of money there. So Schedule E, rental and royalty income. Rental income is good. Now, here's the benefit of real estate. We talked about it before. We'll talk about it again. You get to write off the artificial expense of depreciation and all the interest you paid on the loan. So that HELOC I said move over to your income property now is tax deductible against that income property versus going on Schedule A where you don't lose much of it because of the new tax laws. People, avoid taxes like poison and we both win. And you're only paying your fair share, which the IRS says they want you to do anyway. Realize every $1 million of building value, you're writing off $36,000 of artificial expense called depreciation against your income. If you broke even on $1 million worth of real estate, all the income paid all the expenses, and then you wrote off depreciation, you have a $36,000 loss on Schedule E, which goes against your income from selling real estate on Schedule C. Let's pretend you had $3 million worth of building value in real estate by buying at least 2 properties a year. That's $108,000 of depreciation every year for 27 and a half years. That means if my buildings just broke even, all the income paid all the expenses. I get I don't make any profit. I don't lose any money. Then I go do my taxes. I can write off $108,000 of income from selling real estate against the losses. People, this starts to get pretty darn serious that what the heck, why didn't I talk about an aha moment and an awareness? Do you realize that? And if you just bought 2 a year, you'll have your $3 million long before you know it. I don't care if it's $100,000 units or $500,000 units. Just keep getting that point where all of a sudden I'm reaping the benefits of avoiding taxes like poison legally. That's the rental part. You flip it over, there's the royalty income. Write a book. Write something, do something to get some royalties. I receive royalties from several different sources because I wrote some things and I licensed them to them, and now they pay me every so often, plus royalties of things that I created myself in the process. So royalty income is another source or another multiple stream of income. And we have so much to offer with our expertise. So we're down to the S. Self-employment income, Schedule SE. I have mixed emotions about Social Security, which is why that form is there, because you've got to contribute to Social Security. And I have been fortunate enough throughout my entire life to basically not contribute or contribute very, very little to Social Security. In fact, I'm way past the retirement age of 62, where I could start I could never collect a penny of Social Security. I never put enough money in and don't have enough quarters. I tried to find better ways. I never saw in my life a person that was a friend of my parents or a relative who lived better once they went on Social Security. I didn't think the math didn't seem to work. I never found anybody who was better off. Oh, I'm on Social Security. My life is getting better. That's my personal opinion. But I felt I want to control my whole process. And that goes beyond just Social Security. And you may say, well, Wayne, you're wrong. That's your choice. But in Wayne's world, I felt that it made sense to me. So I chose to have very little self-employment income by having a lot of losses. And the law says if I earn under $400 net income on my business, I don't have any Social Security taxes to pay. Now, that means I get no credits either. So as you do the Schedule SE, you'll see the $400 number. So my goal was always to make as much income as I could, have as many expenses as I can to get it close to or under $400. That was my strategy. And here I am, having the pleasure of being with you, enjoying my life, and not ever looking forward to a Social Security check. It's the first of the month. Doesn't make a difference to me. My Social Security, and I hope your Social Security, is the rental income from the checks that come every month. That's my Social Security. And if I need a pay raise, I sell a building or I raise the rents. That's all I'm trying to tell you to do. Ask you to do and feel what I say. Because I say what I feel. If you feel what I say every week, you're going to have a wonderful future. And you'll be able to whisper your wealth without flashing it around. By its nature, Schedule SE is to make sure the government gets their money for Social Security and you have some money put aside for Social Security. I just never saw it being enough. No different than my crazy philosophy, if you want to call it crazy, of life insurance. I never understood why I'm supposed to bet some company that I'm going to die this year, and they say, no, you're not. And I paid them money, and guess what? I lost the bet. I didn't die. So next year they say, Wayne, here, give us some more money. We'll bet you this year. We'll bet you you're not going to die. I'm betting I will. Year after year after year. The only time I win is when I die. That's not winning. But I realized something. In 1966, Consumers Union came out with a study, and that's almost 60 years ago, 50 some years ago, that said, buy term and invest the difference. And they showed the numbers. And I can show you so many spreadsheets that show buying term and investing the difference was a godsend for me to build wealth. And I could invest that wealth, the difference in real estate. So I bought the term to cover my family, to take care of my children in case I died. But more importantly, I invested the difference in real estate. And I leveraged it on top of that. Maybe it's time for you to think about some of those leveraging strategies. So we got a good beginning. We started thinking about, I guess, why aces are so powerful in poker, but more so, while they're even more powerful in wealth building. So please, now with May being over, we're on our end of the first half of the year. How are you winning with aces this year when you do your tax return? And remember, if I said something or triggered something that you didn't do, you can go back 2 years and appeal your tax return. It's a 1040X form. Now, I'm not an accountant, so I'm not giving you accounting advice. You've got to talk to an accountant. But there might be a reason from what I said to ask an accountant, hey, I just heard that. Should I be appealing my taxes? Excuse me, should I be appealing my taxes by filling a 1040X? I found out I could have been taking this deduction, or I didn't know I could do that, or I didn't know that, or this, that, these, or those, whatever it is. You can go back 2 years. But don't not take advantage of what we're talking about for this year. Ignorance is bliss. You didn't know it 2 years ago, but it's no excuse. Now you know. That was your awareness for today, your aha moment. So you're aware. We know that. We know very simply that once you're aware, you have to decide to do it. And the bottom line is you have to make that decision. What was isn't and what is won't be. And the most powerful words that form a nice little 10-word phrase, each word only 2 letters long, as you leave here today and as you leave here every week. What was isn't and what is won't be. If it is to be, it is up to me. I know what you will benefit from. You have to realize you'll benefit from it and do what it takes. The opportunity cost of not doing this is financially devastating over the long term. That's why the fifth reason why people don't build wealth, they don't understand the time perspective. And we are living longer than we ever did before. I'm very scared for people that are going to be running out of money before they run out of their life. It used to be running money for around a month. It's now people running out of money before they run out of their life because they're living longer and did not save enough, did not invest enough. did not have a passive income to make sure things happen. And once again, we have the most powerful passive income product in the world that we sell. Let's make sure we're buying two at least income properties a year. Every year you are a realtor. Buy more if you want. But if you don't buy them, you're not winning, you're losing. In Wayne's world, I want you to win. Win with inflation, winflation. And as we talked earlier, and we'll repeat again, this is the time for gold, silver, diamonds, and real estate. And food storage ain't a bad thing either. But I just listened to I was on a Zoom call yesterday with a top investment advisor for Merrill Lynch. And she's very conservative. But she said during inflation, the first thing she thought of, although she can't buy it because of a risk factor, is real estate. She said, real estate's the best thing to buy right now. That came from Merrill Lynch advisor. Even though they don't sell real estate or put in their portfolio, they have assets that are real estate based. But the bottom line is she likes real estate. You know what? I love real estate. I hope you love real estate. With that said, I think we've done our job for the day. I wish you a good, long, strong Memorial Day weekend. Have some fun, and we'll see you next week. And